Financial Survival Network, helping you to survive and thrive in the new economy. Get our complimentary newsletter at financialsurvivalnetwork.com. This is the Financial Survival Network.
You are listening to the financialsurvivalnetwork.com. I'm Kerry Lutz on 1230 WBZT. Real estate, interest rates, what's it going to do to you? What's it going to do for you? Because there's always opportunities. And here to talk about them is our old friend, Jason Hartman of jasonhartman.com. Welcome back, Jason.
Hey, thanks, Kerry. It's great to be back on the show.
And you've been traveling quite a bit, as I wish I was.
Yes, I have. I have been traveling all over Europe and taking a little summer vacation, but I've also, as I do, because I'm addicted to what I do, I just love it. I always look at properties in every market I visit, and I've now been to 69 countries around the world. Some of them I've been several times, and I looked at properties this time after reading for the last few years how the property market in Spain has hit the skids, and it's just a great buying opportunity, all these articles I've read, and I got to tell you, I disagree. I was unimpressed largely, especially with Barcelona. It was my second time in Barcelona, and I think there's a lot of desperation in Spain. We talk about the pigs, Spain, Portugal. Well, I guess I should do that in order, right? PIGS. Portugal,
yeah,
Ireland,
sure.
or Italy. That could be either one. It's really a double I. And Greece and Spain, and boy, that economy it's a mess. It's not good.
And you got, what else? You've got squatters all over the place that they don't want you to displace. So you're going to buy a unit illegally occupied. It sounds like Detroit, and then you got to try to get people out of there so you can get your unit, and you're kind of screwed.
Yeah, well, that's a really good point, Kerry, because one of the, what my company basically does, for some of your listeners who may not know who I am or what I do, is I have a real estate investment company, and we help people invest in properties nationwide. We've wanted to help people invest in properties worldwide. We could easily do that, yet in all my travels, I have never found an international market that impresses me more than any of the American markets do. So in the U.S., we've done business now in 48 cities around the U.S. Right now, some of our bigger markets are, any of the big cities in Texas, those have been very good, whether it be Austin, Houston. We're doing a lot of business in Austin, Texas again now. Dallas, pretty good. Indianapolis has been a market for us for a long time. Atlanta. All these markets that make sense, that are what we call the linear markets, that don't, you don't really hear about them on the news. They're not Miami, they're not LA, they're not San Francisco, they're not Boston, they're not New York. These are markets where you can buy and hold a property. It makes sense the day you buy it from a cash flow perspective. This is not gambling, it's not speculation, it's not craziness. And, it just works. It works for the investor. And, that's what we help people do. And, when we look around the world, real estate is just too expensive in these European cities. It's really too expensive in Central and South America so far from what we've looked at. The U.S. has some very unique characteristics that make it quite attractive, not the least of which, and we're going to talk about interest rates, is that the mortgage market here in the U.S. has been subsidized by the government through Fannie Mae and Freddie Mac really since the Great Depression. And that is unique in all the world. That doesn't happen anywhere else. But where I got off on this tangent talking about that is you mentioned squatters. And one of the things we look for is we look for landlord-friendly markets where the regulatory environment, the attitudes of the judicial system there, the judges, and the laws are set up in favor of the landlords. So, my home for most of my life has been the Socialist Republic of California. Okay? And that's just not a good place, because if the tenant knows how to play the game in California, especially in some of the worst, most landlord-unfriendly areas of California, like the People's Republic of Santa Monica and also San Francisco, they can just stay in your property forever. You can't get them out. It's just really tough. And, when you look at places like Texas, for example, where we've done tons of business for many, many years, um, the old saying is don't mess with Texas. I mean, if you got a bad tenant, they're out of there in about 21 days. Okay, no,
Is that right?
no ifs,
Amazing.
ands, or buts. It's pretty easy to get them out. And so, landlord-friendly markets. Of course, there are many other fundamentals that we look for as well, but not the least of which is landlord friendliness. Not we want markets where the judicial system in that area is friendly to our cause as landlords. So if we got a deadbeat that you're going to have once in a while, if you've got, you go through hundreds of tenants, you're going to have a deadbeat here and there, and you can kick them out real easily.
Amazing. So there are markets, unlike New York State, where
terrible.
the tenant actually is at a disadvantage to the landowner or the landlord, as it were.
Yeah, that big evil capitalist landlord. Oh my gosh. They own a house that they rent to somebody else. They must be rich and evil. That evil big land baron.
Yeah, that's great.
The poor little renter who doesn't want to pay his rent wants something for free,
So
my sarcasm.
Yeah, well, hey, it's and similar in other places that you've concentrated in, and I guess in most markets in the country as well, with notable exceptions.
That is for sure. And one of the things that we really thought we would talk about today is interest rates and what will that mean to investors, and also as it relates to real estate investors, what is the impact of institutional investors in a marketplace, whether it be private equity groups or hedge funds or any type of institutional investor. We have those as our clients. We have private equity groups buying through my network, and we have hedge funds buying as well through us. But they really change the market. They create a lot of malinvestment, and the government does this too when they get involved in any marketplace, whether it be real estate or something else. These entities are so big, and they exert so much influence with the money they throw around or the influence they throw around that it really does mess things up. And investors have to be very careful and tread lightly and be aware of what's going on with large institutional pools of money and what they do to a marketplace. Case in point, Phoenix, Arizona, where I live. Okay, I moved here 2 years ago, and we had stopped. We were doing business here a long time ago, and we stopped doing business, timing it almost perfectly in early 2006. And then I got back into the market, started recommending it in, I believe, late 2008. So the timing was pretty good. And, did a lot of business here over the past couple of years, and then pulled out of this market. And, really, although we have contracts with providers in this market, we could certainly be recommending it. But what happened here is we saw all of these institutional investors just rushing into Phoenix. And they were at the foreclosure auctions. They were negotiating with banks to buy their REO pools, their real estate owned, that was, foreclosed on by the bank. And they were just, bidding up the prices. And this is one of the reasons I say of my 10 commandments of successful investing. One of them is commandment number 3, thou shalt maintain control. Kerry, we think everybody should be a direct investor. They should only invest in things that they directly own and have immediate control over. Okay. Now, of course, nobody controls everything. You don't control the marketplace, and that is always changing. But you do control the investment. So we say to people, pools are for fools. Don't invest in a fund. Don't invest in someone else's LLC or general partnership, limited partnership. Invest and buy your properties directly. Own them, control them. And, the one downfall that comes with that is responsibility. If you're in control, you also have a greater degree of responsibility. So what my company does is we make that responsibility a lot easier for the investor, okay, through certain tools and relationships that we offer. But these funds come in, and because it's not their money, they've got so much capital that they need to just deploy as quickly as possible, because it's just like the government. If you want a bigger budget next year, you better spend all your budget this year, which is completely silly, right? It's better to save money and be prudent and not spend all the money if you can. But, there's no way you're going to get an increase in your budget if you don't spend it all. So these funds, private equity groups, hedge funds, they are just deploying capital into these markets so quickly that they basically overpay for properties, and they cause the properties to go up in price. And it's somewhat artificial, because they can move these large amounts of capital around, and then they can decide they want to exit a market. And when they exit, they start putting a whole bunch of properties on the block, all in very close proximity time-wise, and boy, that can really cause prices to soften. And it creates malinvestment, no question about it. So this is why people need to be aware of what is going on. And, we just opened Little Rock, Arkansas. I mean, considered by probably most people as a boring little market, but Little Rock has a lot of great fundamentals that most people probably don't know about. And, they can hear more about this on my podcast at jasonhartman.com or on iTunes on the Creating Wealth Show. And, it's a great little linear market. We like the markets that don't make the headlines.
Sure.
And this is a market where there's really no significant presence of institutional investors. Now, they'll probably follow us in there. Maybe, who knows? They've got their own dynamics with which they're thinking. But, it's a great little market. Properties, they rent for more than 1% of the purchase price.
And that's exactly the opportunity that you're seeking out. And we're going to talk more about that up next on the Financial Survival Network with Jason Hartman, noted real estate investor, jasonhartman.com, on the Financial Survival Network, 1230 WBZT. Jason Hartman has helped thousands of people realize their dreams of financial independence through real estate investing. And now he's got an unbeatable offer for you. He's offering you his proven course that thousands have used to build an income property empire, and it's free to the first 100 Financial Survival Network listeners. Just go to jasonhartman.com/Lutz and sign up today. For cash flow and capital appreciation, there's nothing else like it. Make your money work as hard as you do by building an income property empire. Real estate is America's proven investment. Go to jasonhartman.com/Lutz and get your free course today. That's Jason, HARTMAN.com/Lutz. Thousands have paid nearly $300 for this course, but for this short period of time, you can get it free. And we're back. I'm Kerry Lutz on the FinancialSurvivalNetwork.com. We're with Jason Hartman of jasonhartman.com on 1230 WBZT. So, Jason, you're talking about this little niche market, Little Rock, Arkansas. Who would ever think that you could hit pay dirt in Little Rock? I mean, it's kind of like the Deep South. It doesn't get any deeper than that. And yet you're finding properties renting for more than 1% of their total value per month. I mean,
yeah, you can buy nice, high quality, newer, single family homes for $100,000, and they'll rent for $1,200 a month. I mean, that's 1.2% of the purchase price. Don't try that in expensive markets like Miami, like, virtually anything in California. I mean, California, although it's not a city, it all acts so similarly, the whole state, and there, you buy a $600,000 property, and it only rents for $3,000 a month, 0.5%.
Right.
So the ratio is the key. that 1% RV or rent to value ratio. And we like to do better than that if we can. And right now we can in Little Rock. You can't do it in Atlanta anymore. Atlanta's now 1% if you're lucky, maybe more like 0.9%. Still pretty darn good, but not as good. Houston is pretty good. You can still do 1% or a little better there. Austin, Texas, believe it or not, it's there are some great opportunities out there if you're in the right place.
Yeah, and that's what it's about, is finding the opportunities and making the most of them, which is what you've been doing all these years.
That is, and income property is just the most historically proven asset class that provides access to middle class and upper middle class investors, and gives them a great opportunity to control their destiny, where there's nobody skimming all the profits off the top. You don't have to worry about the CEOs and the boards of directors taking big bonuses. If you own stock in a business, they're just skimming all the profits off the top. You don't have to worry about some investment banker skimming all the profits, or some brokerage house. And it's just I just believe thou shalt maintain control. If I'm gonna buy something, I want to be a direct investor. I don't want to invest in a fund or a pool or anything like that. Direct ownership of assets. That's the way to go.
Yeah, makes total sense. And that's what you've been helping people do for so many years as well.
Yeah, absolutely. Well, let's talk about interest rates a little bit, Kerry. So, it looks like they're going up. I mean, that's your opinion too, right?
Yeah, well, for the time being, I think there'll be a pullback, at least for a while. They'll hit close to 3%. The Fed, I think, will go into full-scale panic mode and do whatever they have to bring those rates back. But eventually, they're going to go up, and I don't think there's any force of nature. I mean, Albert Einstein was fascinated by interest rates. I don't think Einstein could stop them from going up. I think they have to go up.
Well, I totally agree with you. With the amount of debt we have, the rates have just got to go up. There's no way we can attract investors forever, being essentially an insolvent country. Okay. Yeah. When you look at the debt issue, without offering them higher rates, and that is directly tied to mortgage rates, and that means rates ultimately have to go up. We cannot defy the law of gravity forever when it comes to interest rates.
No, can't. We've been doing it quite successfully for some time. But if there's any kind of uptick in general economic activity, which is by no means assured, but at some point probably there will be, that's going to add further fire to the interest rate cauldron, and interest rates will go up that much more. But at the present time, certainly rates are well below their historic mean, and that gives them a little bit of room, so we don't have to panic at this point. But obviously it's going to affect your equations for investors.
It most definitely does. When I was in college, I got my real estate license the first year of college, and I remember I was just doing traditional real estate. Not well. I was working with a lot of investors actually, but in a traditional business. I worked at Century 21, then Remax, and I was just a kid. But interest rates were 14%. And everybody was starting to buy like crazy in the late 80s, and because, 14% seemed great compared to 18%, okay, or 20% in the Jimmy Carter hangover era. So, rates are still incredibly low, just incredibly low. And right now, even with interest rates popping up a little bit from their incredibly low number, I say that the real rate of inflation, and I don't know what your opinion is on this. I'd like you to give it, and feel free to disagree with me, but I'd say that the real rate of inflation for the basics, the necessities of life, right now and for the past few years, has been 9 to 10%.
Yeah, I think you're pretty spot on there.
Yeah,
I totally agree with you.
So if you can borrow money, now investors have to pay a slightly higher mortgage rate on borrowing. But say, for example, I don't know what the rates are offhand right now for investors. This is different than for homeowners. If you own or occupy, your rate's a little lower, okay? But for investors, say you can get a 30-year, 3-decade-long mortgage that won't be paid off until 2043. Just imagine that for a moment. Do you know how much is going to change in this country in the next 3 decades? It's going to be unbelievable, the changes that will happen.
Sure.
And probably the type of rampant inflation we will experience at some point in the next 3 decades, in the next 30 years before 2043. So you can buy today and say you pay 4.5% or 5%, for example. You're getting paid to borrow. Okay, because you're borrowing at a rate lower than the rate of real inflation. And as such, if you bought 10 rental properties and kept them vacant and never put a tenant in them, now you'll have some maintenance costs and some carrying costs, insurance, property taxes, but the mortgage, just a loan, okay, based on just the mortgage, you would be getting paid to borrow. You'd be basically arbitraging the interest rates by somewhere around 5%, the way we do the math. So, you get paid to borrow. Now, lest, people think this is some, theory, some esoteric thesis. No, it's not. It actually happened to tens of millions of people who bought homes in the 70s. Okay, so in 1971,
even in the 40s, 50s, and 60s, Jason, to a lesser extent, but it happened. Sure.
Right. Well, the reason I use the 70s is because at my seminars, when I teach a seminar called the Creating Wealth Seminar, and we've had thousands of people come through that over the years, and it's actually that's the course I gave away on your program last time. We did a special for a freebie on that course, which. The product is available at jasonhartman.com, and we said we'd give 100 of them away. And Kerry, your listeners were so gung-ho about that we didn't shut it off fast enough. We ended up giving 139 of them away.
Oh my God, really? That many?
So, yeah.
Well, I'm glad you're listening. I'm glad you're interested. It's good to know.
Yeah, but at this course, I share a chart, okay, showing not theory, showing actual factual history, okay, where someone could buy a home in 1972, a year after we went off the gold standard in 71, when Nixon closed the gold window. Okay, and all your listeners know about that all too well.
Oh, yeah, they're very intimately aware of that one.
That's when the government was allowed to be completely irresponsible. Before that, it had to be a little responsible because it was, they were tied to something. There was some honesty in our monetary system back then, but now there's just nothing. It's total fiat money nowadays. And so you could borrow on a 30-year mortgage at 7.37%. Okay, 7.37%. And you would have paid that mortgage off by 2001. And over all those years, inflation, it was up during the Carter era, and then it went down. And Paul Volcker really, our Fed chairman, back in the day, really broke the back of inflation by raising the rates. And, that was tough medicine to take. And I think we're going to have to take that medicine again because, if you ask me, we're going to have very significant inflation, which will be great for investors that own income properties. I mean, it'll be
great for debtors.
Yeah, great for debtors and great for commodities holders. And when you buy income property, you're both, because you get a 3-decade-long fixed-rate mortgage, but you're securing it against what I call packaged commodities, all those construction materials that are the ingredients of a house or an apartment building. Think about it. What's in there? Well, concrete, lumber, copper wire, petroleum products, energy, glass, steel. Hey, these are commodities traded globally, that tend to go up in price when you have inflation. They're indexed to inflation. Sure. And the debt, at the same time, is debased or paid off by inflation.
Yep.
I mean, if you owe $1 million in real estate loans and inflation is 10%, A year later, in real dollars, you only owe $900,000. Inflation
Absolutely.
just paid off $100,000 of your debt.
Yep.
So in this chart I was talking about, by the end of the 30 years, after tax benefits and inflation, that person actually got paid, literally paid, 1.16% to borrow that money. And that's someone who didn't have rental income. They lived in that house.
Right.
They didn't just live in that house for free. They got paid to live there over the course of the 3 decades. And this is the hidden wealth creator, Kerry, that has made so many people, tens of millions of people, so wealthy from owning real estate. Most people think, the price of the property went up. Well, that's the outward view of it. But the inward view of it is the debt was debased or paid off by inflation.
Yep, exactly. It pays to be a debtor. On that note, Jason, we got to run. Just give us your website info where we listen to your podcast, and then we'll talk to you again in a couple of weeks, I guess.
Yeah, fantastic. It's jasonhartman.com. That's JASONHARTMAN.com. jasonhartman.com.
All right, great. And you can always go to financialsurvivalnetwork.com. We got loads of links to Jason's site. Jason, we're going to see you next month in Orlando, finally.
Yes, I'll be speaking at the Equity Trust Conference, and that's the largest conference for self-directed IRA and retirement plan investors. And I am one of the speakers at that conference. And Kerry, I'm going to look forward to seeing you there in Orlando.
All right, we will be there. We'll see you soon. Jason, thanks again for coming on.
Thank you, Kerry.
The Financial Survival Network, helping you to survive and thrive in the new economy. Get our complimentary newsletter at financialsurvivalnetwork.com. This is the Financial Survival Network.